Silver may be walking into its biggest Monday of the year. Over the weekend, Iran's oil infrastructure was hit, COMEX silver stayed pinned under a major breakout level, and China started cracking down on silver traders while its own vaults look frighteningly thin. That is not three separate stories. That is one story from three different angles. Physical stress, paper pressure, and a macro shock all colliding at the same time. And if this collision carries into the open, most people are not ready for what silver could do next. By the Friday close, silver was sitting at 84.47. Gold finished near 51.71. Crude was already pressing up near 90 after a violent surge into the end of the week. Then the weekend brought the kind of headline that can reprice an entire market before cash traders even get to their desks. This was not just another battlefield update. This was oil infrastructure. That matters because once oil becomes the target, the market stops thinking only about war and starts thinking about inflation, supply shocks, policy mistakes, and what investors run toward when confidence starts slipping. That is where gold and silver stop being side characters and become the main event. Let me make this simple. Silver is already sitting at the edge of a technical breakout. The paper market is already stretched. Physical inventories are already under pressure. China is already nervous. And now the war risk just moved one level closer to the part of the global system that touches every single asset on Earth: energy. When energy gets hit, everything downstream starts moving. Inflation expectations move. Bond expectations move. Fed expectations move. The dollar reacts. Gold reacts. Silver reacts harder. That is why this weekend matters so much. And that is also why this is not the kind of setup where you should be watching one chart and ignoring the rest. If you only watch silver, you miss the oil shock. If you only watch oil, you miss the paper-to-physical stress. If you only watch headlines, you miss the exchange behavior in China. The real signal is in the overlap. And right now, all three signals are flashing at once. The weekly close is the first thing you need to understand, because most people underestimate how much a weekly close tells you about market pressure. Gold closed above the level it had been fighting with most of the week. Buyers did not just survive. They regained control into the close. That is important because a market that closes strong going into a dangerous weekend is not a market that is relaxing. It is a market that is loading energy. Silver did something even more interesting. It finished just under 85. Not far under it, not rejected by miles, right under it. Close enough that the market can smell the level but not through it yet. That is where tension builds. That is where breakouts are born, or where brutal rejections happen. Either way, that kind of level becomes the hinge for the entire week. And 85 is not just another random number on a chart. It is the line that tells you whether silver is still being contained or whether the next leg higher is starting. If silver gaps above 85 and stays there, the psychology changes instantly. Shorts feel pressure. Momentum traders jump in. Commentators who ignored the move all week suddenly start paying attention after the fact. But if silver pushes above 85 and gets slapped back down again, then the market is telling you the ceiling is still active, and somebody with size is still defending it. That is why this level matters so much. It is not just resistance, it is a verdict. Now let's talk about the part of this story that makes the entire silver market look unstable beneath the surface. COMEX registered silver has fallen to 81.2 million ounces. At the start of February, it was above 102 million. That means more than 20 million ounces of deliverable silver vanished from the registered category in roughly 5 weeks. That is not normal erosion. That is a drain. That is the kind of movement that should force everyone to stop pretending this is a calm market. But it gets worse when you stack that against the paper exposure. March open interest in COMEX silver is sitting above 58,000 contracts. At 5,000 ounces per contract, that is 294 million ounces in paper claims. Put that next to 81.2 million ounces of registered silver, and the imbalance becomes impossible to ignore. You are looking at 3.6 ounces of paper claims for every 1 ounce of deliverable silver. That is not healthy leverage. That is a system functioning on the assumption that most people will never ask for the metal they are technically entitled to demand. And that assumption is the whole game. That is the hidden pillar underneath the paper market. Everyone behaves as if the paper is enough because most players are expected to cash settle, roll forward, or stay inside the casino. But the moment enough participants decide they want metal instead of paper exposure, the structure gets stress tested very fast. A paper market can survive a lot. What it cannot survive is a loss of faith in its ability to convert claims into something real. Historically, people used to get nervous when the paper-to-registered ratio got anywhere near 2-to-1. That was the zone where traders started whispering about tightness. We are not there. We are at 3.6-to-1. And the reason that matters is not just the number itself, it is the direction. Registered silver is falling faster than confidence should be. Open interest is not collapsing fast enough to match it. The gap is not healing. The gap is widening. Every week this continues, the exchange looks a little less like a neutral delivery venue and a little more like a high-wire act. One of the ugliest numbers of the week was the single-day drain. COMEX lost 3.2 million ounces in one day. One day. That is not a background fluctuation. That is the kind of number that tells you pressure is not theoretical anymore. It is active. Yes, there is more silver in eligible inventory, but that does not mean it is freely available to solve every delivery problem. Some of it is spoken for. Some of it is held for other purposes. Some of it exists in the vault, but not in the category that solves a panic if delivery demand spikes. That distinction matters. A lot of people quote total inventory as if all silver in the building is equally available at the push of a button. It is not. So the COMEX side of the story is already dangerous by itself. But then you look east, and the picture gets even more revealing. China just moved against its own silver traders. The Shanghai Futures Exchange cited abnormal trading rules and suspended groups of accounts for exceeding daily position opening limits. Strip away the legal language and the meaning is obvious. Traders were getting too aggressive, too fast, and the exchange stepped in. That is what exchanges do when they think the market is getting too hot in a way they do not want to tolerate. The pattern matters more than one announcement. In January, dozens of account groups were suspended. In February, more. In early March, more again. This is not a one-off. This is a trend. China is not acting like a market with abundant comfort around silver supply. China is acting like a market trying to prevent acceleration. And when an exchange starts actively limiting aggressive participation in a metal that is already showing physical tightness, you should pay attention. Because here is the number behind that behavior. Shanghai's visible silver inventory is around 8 million ounces. 8 million. For an economy with massive industrial silver demand, that is tiny. That is not a cushion. That is a warning light. And if an exchange sitting on that amount is also suspending traders for pressing too hard, then the message is obvious. They do not want a frenzy. They do not want a run. They do not want price behavior that exposes how tight the underlying physical situation may really be. Think about the contrast. In the West, the COMEX keeps operating as if the paper machine can absorb all stress. Vaults drain, ratios stretch, and the structure keeps smiling. In China, the exchange steps in and signals discipline. Same metal, same global market. Two very different responses. One side looks like it is trying to contain behavior. The other looks like it is hoping behavior never changes. That difference matters because when pressure builds globally, the market usually reveals which exchange was reading the room correctly. And now layer on the weekend war escalation. This is what turns a tight metal story into a potentially explosive one. The latest strikes hit oil infrastructure in Tehran. Not just military assets, oil infrastructure. That changes how the market interprets the entire conflict. When oil storage, refining, or export-related assets become direct targets, the risk premium on energy changes immediately. This is no longer just about who fired at whom. This becomes about what happens to oil flows, what happens to inflation expectations, and what happens to asset pricing when traders realize the energy system just got dragged further into the war. Crude had already finished the week close to 90 after a huge surge. That was before the weekend headline had a chance to breathe through a full market cycle. So now think about the setup. Oil was already elevated. Then the market learns that infrastructure tied to Iranian oil has been hit. This is the kind of development that can make traders start gaming out not just short-term disruption, but the possibility of prolonged damage, retaliatory escalation, choke point stress, and insurance risk around shipment routes. Once that thought process begins, oil can move far faster than policymakers are comfortable with. And when oil moves, inflation moves with it. That is the connection precious metals investors have to understand. Higher oil means higher transportation costs, higher industrial costs, higher pressure on consumers, and renewed inflation fear just when central banks want people to believe the worst is behind them. That is where the silver story stops being only about silver and becomes a macro story. Because if oil keeps rising, central banks get trapped. Cut too early, and inflation reaccelerates. Stay tight too long, and you crack growth. That trap has a name: stagflation. And stagflation is where hard assets become dangerous in the best possible way. Not because everything goes up in a straight line, but because trust in policy starts to weaken. The market realizes there is no clean solution. Energy is expensive, growth is weakening, households are strained, and the central bank cannot fix both problems at once. That is the environment where gold starts behaving like a monetary alarm bell, and silver starts amplifying the move with its own volatility and supply constraints. That is why this weekend matters so much. The oil story alone would have been enough to matter. The COMEX stress alone would have been enough to matter. The Chinese crackdown alone would have been enough to matter. All three happening together is what makes this setup different. The physical market is tight. The paper market is stretched. One of the world's key exchanges is already moving defensively. And now the macro backdrop may be about to pour gasoline on the whole thing. Here is the key conclusion. These are not disconnected stories. They all point in the same direction. Real silver is becoming harder to source smoothly inside a market that still relies heavily on paper claims and rolling confidence, while the broader economic environment is becoming more supportive of hard assets because war is now colliding directly with energy. In plain English, the silver market is tightening at the exact same time the macro case for owning silver is getting stronger. Now let's talk about Monday. My base case is that the market opens with a strong reaction to the oil infrastructure strike. That means higher attention on oil first, then gold, then silver. But this is where people make mistakes. They assume the first move will be the clean move. That is not always how headline-driven markets work. Safe haven dollar demand can complicate everything. We have already seen gold spike on war headlines and then reverse when the dollar caught a stronger bid. So yes, the weekend setup favors a higher open in metals. But whether that move sticks depends on what the dollar does, and whether silver can take 85 and hold it. That is the level I am watching above everything else. Not 84, not 86, 85. If silver reclaims it and holds, the whole tone changes. If it tags it and fails again, then the market is telling you the battle is still unresolved. One level, one signal. One of the clearest tells you will get all week. But even beyond Monday, the bigger picture is what matters more. A market cannot sit forever with this much paper stacked over this little deliverable silver and expect confidence to remain untouched. A market cannot watch visible stocks shrink, watch another major exchange start suspending aggressive traders, and pretend nothing unusual is happening. A market cannot absorb a fresh oil shock in the middle of war and act like the macro backdrop for precious metals is neutral. Sooner or later, one of these tensions wins, and when pressure builds in multiple directions at once, release is usually violent, not polite. That is why silver right now feels less like a quiet chart setup and more like a sealed chamber with every bolt getting tightened. Physical supply pressure, paper overextension, exchange intervention, energy war risk, inflation risk, Fed pressure, dollar uncertainty. None of these valves is loosening, they are all tightening together. And markets do not stay composed forever when that happens. I am not telling you the exact price Monday morning. I am not pretending anyone can map every headline in a war hour by hour. What I am saying is that the data is louder than usual right now. COMEX registered silver near 81 million ounces. Paper claims around 294 million ounces. A 3.6 to 1 paper to registered ratio. Shanghai inventory near 8 million ounces. Trader suspensions piling up. Oil infrastructure hit over the weekend. Silver closing right under a major breakout level. That is not background noise. That is a market shouting. So now the question goes to you. Does Monday become the moment silver finally punches through 85 and forces the market to acknowledge what has been building? Or does the cap hold one more time and buy the paper system a little more time? Do you think the oil strike becomes the inflation catalyst that changes everything? Or does the market absorb it and wait for the next shock? Drop your view in the comments because this is one of those weekends where the smartest read is not always the loudest one. And if you are watching this before the open, share it with somebody who follows silver but is only looking at the chart and not the structure underneath it, because the chart alone does not tell the whole story. The vault drain matters. The exchange behavior matters. The oil headline matters. Put them together and you get a very different picture from the one most people will see on a price ticker Monday morning. If you want coverage that follows the pressure points the mainstream leaves out, subscribe now. And if you are already in, stay sharp. This is not the kind of week where you blink and nothing changes. This is the kind of week where one level breaks, One policy signal shifts, one delivery problem grows, and suddenly the market you thought was stable looks completely different. Watch 85, watch the dollar, watch oil, and above all, watch the physical stress underneath the paper price, because that is where the real story is hiding.